As the final days of 2025 ticked away, a sense of calm settled over Asia's bustling financial centers. The usual hum of activity faded, replaced by a quieter, more contemplative atmosphere. Asia's financial markets entered a familiar year-end lull, a tradition that repeats itself every December as the world's largest economies slow down for the holidays. On December 29th, most stock exchanges saw little movement, with trading volumes thin as many investors had already closed their books for the year. The once busy trading screens flickered with fewer updates, and the echo of footsteps replaced the usual buzz of traders. This period between Christmas and New Year's is typically quiet, with markets drifting and volatility low. The closing bell rang out over nearly empty halls, marking the end of another subdued session. The subdued mood reflected a pause after a year of shifting economic forecasts and central bank policies. Many traders took this time to review the year's ups and downs, considering how global events and policy changes had shaped the markets. 2025 had been a year marked by uncertainty and adaptation. From fluctuating commodity prices to evolving trade relationships, investors navigated a landscape that demanded both caution and agility. Central banks, especially the U.S. Federal Reserve, played a pivotal role, with their decisions on interest rates closely watched across the globe. As the year drew to a close, investors focused on finalizing positions and preparing for 2026, rather than making bold moves. Many chose to step back, reassess their strategies, and ensure their portfolios were balanced for the uncertainties ahead. The calm was a welcome breather, especially after a strong rally fueled by expectations that major central banks, led by the U.S. Federal Reserve, were done with rate hikes. This optimism had lifted markets in the final quarter, giving investors a sense of relief after months of speculation. For many in the financial community, this was a moment to reflect on the lessons learned in 2025. It was also a chance to celebrate achievements, acknowledge challenges, and set new goals for the coming year. For most, it was a time to reflect on the trends of 2025 and look ahead to the new year's challenges and opportunities. Conversations turned to what 2026 might bring: new policies, emerging markets, and the ever-present question of global economic stability. Across Asia, the markets held steady, waiting for the first signals that would set the tone for 2026. As the sun set on another year, a sense of anticipation lingered, with investors poised to respond to whatever the new year might hold. While most Asian markets drifted, South Korea's KOSPI index surged 1.7%, making it the region's clear standout. This rally was driven by heavyweight technology stocks, underscoring the sector's influence on the Korean market. The surge highlighted how even in quiet times, sector-specific news can spark significant moves. South Korea's performance was a signal of growing optimism around its tech sector's recovery. The KOSPI's gains were not just a one-day event, but the result of building momentum in technology. As we'll see, the rally was led by names recognized worldwide. On this quiet day, the big story was all about tech. The KOSPI's rally centered on SK Hynix and Samsung Electronics, giants in the global semiconductor industry. SK Hynix shares soared nearly 6% after being removed from an investment warning list, reigniting investor confidence. This move signaled strong belief in the company's growth, especially as demand for advanced memory chips and AI accelerates. Samsung Electronics, the world's largest memory chip and smartphone maker, also rose 1.5%, providing a major boost to the index. The combined strength of these two companies powered the market higher. Their performance reflected expectations of a robust semiconductor recovery, driven by AI and digital transformation. Seoul's gains were a vote of confidence in South Korea's tech leadership. Elsewhere in Asia-Pacific, the mood was more subdued. Japan's Nikkei 225 edged down 0.3% after a strong year, while the broader Topix managed a slight gain. Investors in Japan were largely in a holding pattern, awaiting new catalysts and potential policy shifts. Australia's ASX 200 also slipped 0.3%, reflecting commodity market uncertainty and the same year-end quiet. These modest declines contrasted sharply with South Korea's rally, illustrating how different markets respond to their own drivers. For Tokyo and Sydney, it was a day of patience and consolidation. In Greater China, sentiment was cautiously positive but restrained. Shanghai's composite index rose 0.3%, and Hong Kong's Hang Seng gained 0.4%, small steps after a tough year for Chinese equities. The uptick suggested some investors were bargain hunting, but conviction remained low amid ongoing economic challenges. Beijing's stimulus measures may be starting to stabilize markets, but investors want clearer signs of recovery. Hong Kong's modest gain did little to change the narrative of underperformance. The day's trading reflected a market at a crossroads, hopeful, but still waiting for stronger momentum. As 2025 ends, all eyes are on Beijing for further policy action. India and Singapore epitomized stability, with both the Nifty 50 and Straits Times Index trading flat. This lack of movement reflected markets coasting into year-end after strong performances, especially in India. Investors were content to hold positions, confident in the underlying growth stories. Singapore's flat session showed resilience, with no new catalysts to move the market. Both markets demonstrated maturity and optimism for 2026, needing no last-minute adjustments. Their quiet finish underscored the diversity of Asia's investment landscape. It was a calm end to a successful year for both bourses. No look at Asian markets is complete without considering Wall Street's influence. U.S. stock indices ended the previous week slightly lower, but optimism for a Santa Claus rally lingered. During Asian hours, U.S. futures were flat, signaling no major surprises from the world's largest economy. This stability reassured Asian investors, as Wall Street's mood often sets the tone for global risk appetite. Many Asian companies depend on U.S. demand, making American economic data crucial for regional markets. International investment flows from the U.S. also shape Asian stock performance. When Wall Street is optimistic, capital flows into Asia. When fear rises, it retreats. The U.S. remains a key barometer for every Asian investor. The U.S. Federal Reserve's interest rate policy is the single biggest factor for Asian markets. Every decision made by the Fed sends ripples across the globe, influencing not just Wall Street, but also the bustling financial centers of Asia. Investors, policymakers, and business leaders in the region pay close attention to every statement and forecast from the Federal Reserve, knowing that even a hint of change can impact their economies. After 2 years of aggressive rate hikes, expectations are high that the Fed will start cutting rates in 2026. This anticipation has become a central theme in market conversations, with analysts debating the timing and scale of potential cuts. The prospect of lower rates is already shaping investment strategies, as market participants try to position themselves ahead of the curve. Lower U.S. rates would ease debt burdens for Asian companies and make their stocks more attractive. Many Asian firms borrow in dollars, so a drop in rates means lower interest payments and improved profitability. This, in turn, can boost confidence among investors, encouraging more capital to flow into Asian equities and corporate bonds. A weaker dollar would boost Asian exports and make commodities cheaper to import. For export-driven economies like China, South Korea, and Vietnam, a softer dollar means their goods become more competitive in global markets. At the same time, lower import costs help manufacturers and consumers alike, supporting economic growth across the region. For global investors, this currency effect increases the appeal of Asian markets. As the dollar weakens, returns from Asian assets become more attractive, drawing in fresh investment from around the world. This influx of capital can drive up stock prices and support new business ventures. The prospect of Fed rate cuts has fueled recent rallies and underpins current optimism. Investors are betting that easier monetary policy will unlock new growth opportunities, especially in sectors like technology, manufacturing, and green energy. This optimism is reflected in rising stock indices and increased trading activity across Asia. Investors across Asia closely monitor every Fed signal, knowing it could unlock further gains. From major institutional players to individual traders, everyone is alert to the possibility of a policy shift that could reshape the investment landscape. The anticipated shift in U.S. policy is the foundation for hopes of a strong 2026. As the countdown to potential rate cuts continues, Asian markets remain energized, driven by the belief that a new era of growth and opportunity is just around the corner. As 2025 draws to a close, investors are already shifting their focus to the key themes and risks that will define the financial landscape in 2026. The end of one year is always a time for reflection, but it's also a moment to look ahead, anticipate change, and position portfolios for what's next. Across boardrooms and trading floors, the mood is one of cautious curiosity. What will the new year bring, and how can investors stay ahead of the curve? The biggest question on everyone's mind is whether the Federal Reserve will actually deliver on the widely expected interest rate cuts. After months of speculation and shifting forecasts, investors are eager for clarity. The Fed's decisions will ripple through global markets, affecting everything from borrowing costs to currency values. A misstep or surprise could trigger volatility, while a steady hand might reinforce confidence and support further gains. Global economic health is under intense scrutiny, with hopes pinned on a so-called soft landing, a scenario where inflation cools without tipping major economies into recession. Investors are watching for signs of resilient growth in the US, Europe, and China, as these regions set the tone for worldwide sentiment. Any unexpected slowdown or surge in inflation could quickly change the outlook. In Asia, China's ongoing recovery and the government's policy moves will be critical to watch. Will Beijing introduce new stimulus measures to boost growth, or will it take a more cautious approach? Meanwhile, Japan's central bank is considering a historic shift away from negative interest rates, a move that could reshape capital flows and impact global markets. India's reform momentum is also in the spotlight, as the country continues to implement changes aimed at unlocking economic potential and attracting foreign investment. At the same time, investors are closely monitoring Beijing's stimulus efforts, which could have far-reaching effects across emerging markets and beyond. For investors, 2026 will demand a global perspective and a keen eye on shifting trends. Interest rates, economic growth, and government policy will all play pivotal roles in shaping returns. Navigating these crosscurrents will require flexibility, discipline, and a willingness to adapt as new information emerges. South Korea's ongoing technology rally is a reminder that, even in uncertain times, innovation can create pockets of opportunity. However, investors must remember that macroeconomic forces, like interest rates and global demand, will ultimately set the broader direction for markets. As the new year begins, there's a sense of cautious optimism in the air. Investors are hopeful, but they know that optimism will be tested by fresh economic data, policy surprises, and the ever-changing tides of global finance. Staying informed and agile will be key to navigating the challenges and opportunities that 2026 is sure to bring.